Hi, I'm Michael Landsberg, Chief Investment Officer of Landsberg Bennett Private Wealth Management. Welcome to our first quarter 2026 update. Before we jump into 2026, let's talk a little bit about kind of the themes that we saw that came out of 2025. First overarching theme that we saw was earnings expectations were much lower than they needed to be for much of Wall Street. Wall Street kind of missed a lot of the earnings expectations that we saw happening. We thought earnings were going to be stronger than expected, and they were. About 6 months ago, Wall Street was at 3% earnings growth. We were at 9%, and we started to see low double-digit earnings growth. The markets tried to catch up a little bit by raising it to 7% and then to 9%, but never has really caught up to it. It's part of the reason why institutionally a lot of hedge funds and investment managers underperformed, because they were so negative on what they thought earnings were going to be. Part of that's political. I think a lot of people are reading into things and kind of making second guesses about what's going to happen politically, as opposed to looking at what data is being presented. They're doing what we always tell you not to do, which is invest emotionally. So the data tells us that earnings were going to be pretty strong, and it was. We were positioned to take advantage of that. And even though we were positioned, a lot more aggressively than Wall Street, we actually even underestimated earnings. We were at that 9 to 11%, and they came up 12, 13% earnings growth. At the end of the day, earnings growth, the growth that earnings have year over year is what drives stock prices. It may not be exactly 1-to-1, but if a company keeps growing its earnings quarter after quarter, the stock eventually will go higher. And that's kind of always been our belief. That's kind of our mode in terms of how we invest. We're seeing a similar situation right now as it comes to inflation. For years, we told you that the Fed has been wrong, and for the most part, they have been wrong. They told you it was transitory when it went to 9%. They told you it was going to go to 2% when it started to go higher. And right now, they're still in an environment that they think inflation is going to be a little higher than we think it's going to be. We actually think inflation is going to trend lower. I don't know if it's going to get to 2.00%. Headline CPI, but we think the next few months you're going to head towards that 2.25% environment. That's a very good environment for lots of stocks, and we think stocks will continue to go higher because as inflation goes lower, that puts more money back in most people's pockets. The primary driver to this is oil, and oil has trended lower. Basically, in the last year, oil prices are down about 25%. That's a big component for most people that watch, because you're obviously putting gas in your car, oil in your house for those of you watching from up north. But the idea here is when that goes lower, that's basically a tax cut or a pay raise for anybody that's watching this. That's a positive for consumer spending. People have more money in their pocket, they'll spend more money. One of the other things that oil prices tell us about is it tells us to kind of stay away from the geopolitical. Right now, if you watch, every time you turn on the TV, depending on what channel you're watching, there's a lot of saber rattling. Oh, we're going to be going to war in Venezuela, and we're going to be going to war in Greenland, and we're going to be going to war in Iran. I tell you, most of that stuff is probably not going to happen. And the primary driver that we look at is oil prices. About 4 to 6 weeks before Russia invaded Ukraine, oil prices spiked. The futures went higher, and we had an invasion. The futures markets pretty much figure out when something's going to go on. If you started to think, or we started to see that oil prices were moving higher in the futures markets, I'd be a little bit more concerned about us going and having a military action with any of these countries. Again, a longer term military action. I don't mean the 20 minutes that we spent in Venezuela, but I mean something that was boots on the ground. We just don't see that. Now, I think that kind of saber rattling by parts of the media is actually good for stock prices because it gives you an opportunity to go into some stocks that we may not have owned, trying to buy some things on sale. The hardest thing we've had to do in the last 12, 18 months is to find things on sale. Lots of stock prices have moved higher, and anytime there's an opportunity to buy the dip, we've been trying to do that, reallocating to some of those areas that we think are going to continue to do well. Obviously areas like AI. Artificial intelligence is here to stay whether we like it or not. The primary focus that we look at is instead of just owning chip companies, which are the ones that get most of the attention, we believe in this idea of we call picks and shovels, which is we want to buy everything that's associated with artificial intelligence. So not only is it the chips, it's going to be, for example, the data centers. And how do you construct a data center? How do you cool a data center? How do you get power from the power plant to the data center effectively through cabling and copper wires? How do we actually generate power more than we've got, whether that be nuclear? So you'll see kind of our investment thesis in our artificial intelligence is very, very broad because we think it's a big ecosystem. It's basically, we're in the first or second inning of probably a 9-inning game in AI. We don't know who ultimately is going to be the winners and who basically can implement artificial intelligence to drive profits. But we do know if there's a gold rush and we're out here selling picks and shovels on the way to California, we're probably going to do pretty well. There might be somebody that does better than us that actually finds all the gold in California, but if I'm in Nevada and we're in Nevada and we're selling basically picks and shovels to anybody going out there, we're gonna do pretty well. That's been our thesis for the last couple of years. It's worked well. We think it will continue to work well until we get an idea of what's actually gonna win. The second phase of AI is what we call agentic AI, which is these AI agents will be doing things for you. Book me a flight. Find the cheapest this and that. And those are the businesses I think they're going to do well. We don't know who's going to win that race, but we do know in order to be in that race, you're going to have to basically be buying running shoes and shorts, and that's that picks and shovels that we talked about. The other thing that we think is continuing to do well is our Aging in America theme. It's almost an aging and worldwide theme, but the concept is everybody watching this is older, people are living longer, and when you live longer, you consume more, but you also have specific needs. You have needs around knee replacements, hip replacements, continual care retirement centers. There's cruise lines that are specifically tailored to people watching this. There's no families on the boats. They're basically tailor-made for people watching this video. That's a good theme that's not going to go anywhere because the vast majority of wealth in the country is owned by people such as yourself. A lot of 20-year-olds don't have any money to spend, so we don't like to invest in businesses too much that are targeting a group of people with no money to spend. Stocks and companies that have products and services that you want to buy is really what we want to be looking at because you're actually the biggest consumer. So the idea that that continues we think is very important, and people are living longer. The other theme that we've continued to like and will do well is kind of this obesity theme. All the drugs, the GLP-1 drugs that allow people to lose weight, they're currently in the shot form. You're seeing that, testing and going to pills. Pills are going to be cheaper and they're going to be more widespread. That should be a continued runway for a long way. Also, there's a lot of other positive effects that these drugs provide, whether it's losing weight to do knees, lowering cardiac risk profiles, helping people live longer. We see this being a trend for a while. As people live longer, they're going to need to spend more money longer term. One of the themes that we saw in 2025 is, and we've talked about this a while, is international diversification has worked. In fact, as well as the S&P 500 did last year, and our domestic portfolios did well, the best performing portfolio we had was our international portfolio. We think that continues, primarily just because of the catch-up. For a couple of decades, international did better than the US. And so what's happened is the last 6-7 years, the US has done better. That regression to the mean is typically we think international will do a touch better because there's some growth rates over there that are, I think, interesting, but also some of those stock prices haven't moved up as much as some of the stuff in the US. Some parts of the US market are a little bit frothy. We don't really see that much internationally. So we'll continue to talk to you about having money overseas. And again, not in the craziest places overseas. We don't need to go to the emerging markets to find returns. We can find returns in big European companies that you use in your home, Japanese companies, etc. We think that trend continues. One of the things that we've done, and by the time you watch this, our rebalance for the first quarter of 2026 will be done. We've added additionally some money to alternatives. So alternative last year were one of our better performing asset classes. It did almost as well as stocks did last year. If you remember, alternatives are things like gold and silver, real estate, commodities, things like that. And the idea behind that is to get a return that zigs and zags when stocks and bonds kind of zig and zag, a different return. And what we did a couple of years ago was we realized the returns in bonds aren't going to be good. And the biggest concern we have for you that are watching this is inflation. Even though I told you inflation's coming down, it's still compounding on very high levels it was a few years ago. So things are still 20-25% more than they were a few years ago. As a retired person, your biggest concern should be stuff's going to keep costing me more and more money, whether it's home insurance, car insurance, your bill at the club, going to travel, whatever it's going to be. We need to continue to grow your dollars at a rate higher than inflation. And I'd say higher than your inflation, not the lowball number the government gives you. So what we did a couple of years ago is we realized that bonds weren't going to give us the returns that we're going to need. So what we did was we took a portion of our bond exposure and added those to alternatives. The nice thing about that, it was the same risk level. The whole reason for you to own bonds is to be a ballast, if you will, against stocks, is to have a risk that's lower that's going to offset some of the kind of the bumpiness that stocks provide. The alternatives can provide basically that same level of diversification with the same level of risk, but the return has been slightly better. That's part of one of the reasons you'll see, a major reason, that a lot of the large universities, endowments in the country have a large amount of money allocated to alternatives. Now, the difference between what we own and what they'll own is we own a lot more of what we call liquid alternatives, things we can get rid of, things that aren't tied up for years and years and years, and the lower risk of the alternative. Like some of the aggressive things that universities and endowments will own, they can own them for 10 or 20 years, and it could be brand new companies that have no track record. That's not the kind of alternatives we're buying. We're going to buy things that are very liquid, but also the purpose is to diversify the portfolio, not to hit home runs, but basically get a return a little bit better than bonds for the same risk. And that's worked out very well. In fact, actually, alternatives last year in your portfolio did twice as well as the bonds. The idea is, as long as it beats bonds with the same level of risk, we think it diversifies your portfolios and keeps your risk level low. At the end of the day, that's really what we're trying to do, is make sure we get good returns with a commensurate amount of risk. So what's happened in the market is more and more people own fewer and fewer stocks. And the problem is when those have a hiccup, like they did last March to April, everybody feels it. So we don't have as much exposure to those stocks as the market does. We own those stocks, and you know the ones we talk about, the Mag 7 names. But what happens is we don't own quite as much of those. So when things are going straight up, we'll tend to lag. But when they fall on their face like they did last March and April, we're not going to fall down as much. And that's important because at the end of the day, the goal is to compound your returns over time. It's not to have you open the statement and suffer a mini stroke because you looked at the statement and said, I just lost 10% of my money. And we don't really want anybody suffering a heart attack or anything like that when they're looking at their statements. So the goal is to provide a clean return, but have less and less bumps. Think of it like a better shock absorber. And over time, what happens is if we avoid losses, we end up basically meeting your goals and objectives, which obviously the last couple of years has been easy. Market's been higher, we've done really well, but we always look at what can go wrong. And so what we look at going wrong is let's make sure that we're defensively positioned. That's why we rebalance. So last year stocks did really, really well. We trimmed some of the stocks, we added to alternatives and a little bit of bonds just because stocks did the best. When things do the best, that's the time to trim a little bit off of it and add the things that are undervalued. And we think over time, as rates go lower, we think we're going to be in an environment where stocks continue to do well. We think areas like gold will continue to do well, and that's why that's an allocation for us. So that diversification is a theme that we've continued to have. We think it serves us very well and you very well, meeting your goals and objectives, not losing sight of the risk that we want to take. One of the things that we see and we hear from folks that are new is that this focus on how did the market do? Well, if you're 50% in stocks, an index that's 100% in stocks is not a relative benchmark. It's almost like me saying, well, how did my car do in a race? Well, I have a pickup truck and you have a Ferrari. Well, guess what? That doesn't make sense to compare those. What we want to look at is how did my pickup truck do against another pickup truck? How did my sedan do against another sedan? So that's the idea that we want to look at, is what risk level. In other words, not apples to oranges, but red delicious to red delicious. And when we look at that context, we feel very comfortable. We've provided really good performance based on the risk that we want to take. Clients have a tendency when things are going higher to want to up their risk level. And that's usually a mistake. Typically what you want to do in an environment is you want to have your allocation to risk based on how you feel all the time. Because typically what we see happen is when things are going up, everybody wants to have more risk. And when things are going down, everybody wants no risk. And that's typically what we talk about. That's buying high and selling low. And that's the opposite of what we want to do. We want to maintain your risk through good markets and bad markets because that will allow you to capture the returns. By being emotional and being more risky when things are going well and being less risky when things are bad, what ends up happening is you sell at the bottom and you buy at the top. Our process kind of forces us to trim at the top and add at the bottom, which is why historically we do well over a long period of time, because we do the opposite of what the average investor does. We're unemotional investors, and that's important to keep in mind. Emotions are great. Holidays, you can get emotional. Like Valentine's Day, that's emotional time. Great things to be emotional is everything but your investing. Investing needs to be done with your head, not your heart. And what we try to do is implement strategies and procedures that keep us up here and not here. Typically here is not a great place for people to make assumptions. They make bets based on their heart and their gut. And the obvious thing is we want to look at data. We want to look at where we are and not get emotional with the headlines that we see on TV. This is going to happen, that's going to happen. We really don't care too much about what happens in Washington. I've said this many times before. I look at what companies report for earnings. Earnings are important to us. That's really the number one driver of what we invest in. Is the companies that we own, are they making you money? And are they growing that over time? We want to invest in those. If they're not growing the earnings, we want to be out. If inflation's going down and growth is going up, that's a good environment for us to be investing. And that's kind of the environment we think we're in, at least for the next quarter or two. We think there's going to be a positive surprise in how low inflation is, and I think that's going to surprise some people on Wall Street and some investors. We think that's a positive, and we're positioned for that. So again, hopefully over the next quarter or two, we'll be in touch with you to let you know kind of where things are. Again, hopefully you had a good start to 2026. 2025 was a great year. Hopefully everybody has a healthy and prosperous start to the new year, and we look forward to seeing you again.